Welcome back to Investing Talk Podcast.
Today, we are looking at a company that is essentially trying to rewrite the rules of gravity in the tech sector. We're talking about Nebius Group.
Nebius, right.
And honestly, if you haven't been paying attention to this one, you might want to pull up a chair because this is shaping up to be one of the most fascinating, high-stakes stories in the entire market right now.
This is the name popping up absolutely everywhere lately. It feels like you can't read a tech blog without seeing them mentioned.
It is, and for good reason. The elevator pitch here is pretty straightforward, but, incredibly powerful. Nebius is positioning itself as the picks and shovels leader of this massive AI infrastructure boom.
The classic gold rush analogy.
Exactly. While everyone else is fighting to build the next great AI model, Nebius is selling the heavy machinery required to run them. And the numbers they are putting up are, frankly, startling. In Q3 2025 alone, they posted 355% year-over-year revenue growth.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep the lights on and the data flowing, so please hit that button.
So yeah, 355%, that's a wow stat if I've ever seen one.
It is a massive number, I'll give you that. It grabs your attention. But this is where I have to, put on my skeptic hat and pump the brakes a little bit. We are looking at a company trading at a valuation multiple of roughly 60 times sales.
60, yeah.
Not earning sales. I mean, that is rarefied air.
Mm-hmm.
And at the same time, they are hemorrhaging cash on capital expenditures. So the tension here is palpable. Is this a bubble waiting to pop, or are we actually looking at the next hyperscaler?
That is the multi-billion-dollar question. And to answer it, we can't just look at the hype. We have to look at the engine under the hood.
Exactly. So let's unpack this properly. Let's start with the fundamentals. We mentioned that growth, but where is the money actually coming from?
Right. So if we look at the first 9 months of 2025, Nebius brought in $302 million in total revenue. The third quarter alone was $146 million of that. So you can see the acceleration right there.
Okay, so $146 million in a quarter. That's decent for a startup, sure. But for a company valued the way they are, I mean, it's a nearly $25 billion market cap. That math just doesn't check out yet.
If you look at the snapshot today, you're absolutely right. It looks incredibly expensive. But the bull case isn't about today. It's about the inflection point they're projecting. They have issued guidance that, frankly, sounds impossible.
Okay.
They are projecting their annual recurring revenue, or ARR, to hit between $7 and $9 billion by December 2026.
Whoa, slow down. 7 to 9 billion from a run rate of what, maybe $1 billion now if we're being generous?
Less than that, yeah. It's a 7-fold increase. That is the guidance.
That feels aggressive.
Yeah.
Usually when I see that kind of hockey stick growth, I assume it's a PowerPoint dream, not reality.
It is incredibly aggressive. But here's the key. It's not just a wish list. It's backed by signed contracts. This isn't, we hope to find customers. It's, we have the customers, we just need to build it out. Analysts are already projecting $7.8 billion in revenue for 2027, with over $5 billion in adjusted EBITDA.
Okay, can you just define EBITDA quickly for everyone?
Sure. It's earnings before interest, taxes, depreciation, and amortization. It's basically a measure of a company's core operating profitability. It tells you if the actual business model makes money.
So generating $5 billion in EBITDA would make them a highly profitable cash machine.
A massive cash machine, yeah.
But promises are cheap. Do they have the backlog to prove it? Because growth that fast, it just smells like vaporware, unless you have signatures on paper.
They have the signatures. They have a backlog exceeding $20 billion.
20 billion.
Over 20 billion. And we aren't talking about small startups here. The key clients are giants. We're talking about a deal with Microsoft worth over $19 billion and another deal with Meta worth $3 billion.
Okay, that changes the calculus. When Microsoft and Meta are signing checks that big, it validates the tech. But my skepticism kicks in again. Contracts are great, but can they actually build the capacity?
That is the critical question.
It's one thing to sell it. It's another to actually buy the land, secure the power, get the chips, and turn it all on.
And that brings us to their competitive moat. Nebius isn't just renting out servers. They have a full-stack platform. They're a tech partner.
And they're pretty tight with Nvidia, right? Which is everything in this market.
They are a cloud partner with Nvidia. That's like having a golden ticket. It gives them early access to the cutting-edge hardware, the Vera Rubin, NVL72, and the Blackwell Ultra systems.
And so while everyone else is in line, they're at the front.
Exactly. And on top of that, they boast a 20% power efficiency advantage over their competitors.
And why does that matter so much? Is that just a PR thing?
Oh, no, it hits the bottom line hard. In the data center game, power is your biggest operating cost. It's the electricity bill. If you are 20% more efficient, your margins are just going to be that much better.
Right.
Plus, there's a shortage. Goldman Sachs data I saw said the market is facing a 9-gigawatt supply shortage. Nebius is sold out.
So they have pricing power.
Huge pricing power.
Okay, so the demand is there, contracts are there, tech seems solid. Let's look at the checkbook. You can't pay for GPUs with promises.
Right. Their balance sheet is complex. They have about $4.8 billion in cash.
That's like a lot.
It does.
It
But
does.
they also have about $4.6 billion in debt. So their net cash is effectively neutral, about $200 million.
That is not a big buffer for a company trying to build an empire.
No, it's not. And their free cash flow is negative. They are burning cash. To put it in perspective, building just 1 gigawatt of capacity costs about $10 billion in infrastructure, plus another $20 to $30 billion for the GPUs.
Ouch. So they're in high spending mode, to say the least.
They have to be. It's a land grab.
Right. So fundamentals are a mix of explosive contracted growth and terrifying capital requirements. Let's pivot to the charts. What is the price action telling us?
Well, 2025 was a banner year. The stock basically surged over 200%, so the market definitely woke up to the story.
And where are we sitting now?
Currently trading right around that $99 to $101.1 level. It's been consolidating there for a bit.
And technically, is the trend holding up?
It is. The stock is staying above both the 50-day moving average, which is around $93, and the 200-day, which is down in the $86 to $88 range.
So the uptrend is still intact.
Right. Despite the recent volatility, the structure is still bullish. And just for context, a $100 investment 10 years ago would be worth nearly $780 today. That's a 22% compound annual growth rate. So this isn't some fly-by-night operation.
But let's talk about that volatility. I'm looking at the beta, and it's 4.0. That is wild.
It is. A beta of 4.0 means when the market moves 1%, Nebius tends to move 4%.
So if the S&P 500 has a bad day, Nebius has a terrible day.
Correct. But if the S&P has a good day, it amplifies the upside. You need a strong stomach for this one.
No kidding.
And there's another factor adding to the volatility here, short interest.
Ah, okay. Are people betting against them?
Short interest has climbed to about 15.5% of the float. That's roughly 33 million shares sold short.
That's pretty high. Anything over 10% catches my eye.
It's high enough to create a, let's call it a powder keg situation. The days to cover is about 2.76 days.
Meaning, if good news hits, the shorts could get squeezed.
Exactly. If they get a blowout earnings report, those shorts could be forced to cover, which drives the price up rapidly, which forces more shorts to cover, and you get a classic short squeeze.
A potential rocket strapped to its back. Okay, speaking of news, let's move on to sentiment. Checking the market pulse, what are people feeling?
So, checking data from Alpha Vantage, the sentiment is definitely weighted bullish. The news cycle is just completely dominated by the Nvidia partnership and those massive deals we talked about.
It's hard to be bearish when you're partnered with the biggest companies on earth, right?
The smart money seems to agree. We saw Fred Alger Management list Nebius as a key holding in their small cap focus fund. The institutions are betting on those long-term contracts.
However, I have seen some headlines about insider selling. I saw names like Kira Rudinsky, Arkady Veloz. When I see leadership selling, I get nervous.
It's a fair question, and it's something you have to look into. But if you dig into the filings, these are mostly sell-to-cover transactions.
So for taxes, not because they're losing faith.
Exactly. When they get stock grants, they owe taxes on them. They sell a portion just to pay the bill. It's automatic. For example, Rudinsky sold about $43,000 worth of stock.
Which, for a $25 billion company, is basically nothing. It's a rounding error.
It is. It looks like routine financial planning, not a loss of confidence.
Okay, that's good context. It's easy to read a headline and panic.
Always.
Now, we have to look at the risks. We can't just paint a rosy picture. What's the bear case?
Execution and capital intensity. That is the hard problem. They have promised huge capacity, but to build it, they need to spend roughly $30 to $40 billion.
A staggering amount of money. And they have, what, $200 million in net cash?
Right. So they don't have that sitting in the bank. They'll likely need to raise 10 to 20 billion in debt or equity.
Which means dilution for current shareholders.
Yes. Your slice of the pie gets smaller.
And then there's the valuation trap we mentioned at 60 to 64 times sales.
It's priced for absolute perfection.
Zero margin for error. If they miss those 2026 targets, the stock won't just dip, It could crash to, what, a 6x multiple?
That would be a bloodbath. You'd lose 90% of your value.
And what about macro risks?
There's that, too. New U.S. tariffs on Europe are a headwind. There's also increasing scrutiny on electricity usage for data centers.
A real concern, yeah.
And we can't ignore the concentration risk. We celebrated the Microsoft and Meta deals, but they're so heavily reliant on just those two clients.
It's a double-edged sword. If one of them renegotiates or walks away, the whole thesis just breaks.
It does.
I've also heard some speculative rumors. Anything to the M&A chatter.
There is unconfirmed chatter about acquisition interest from other hyperscalers. It makes sense. If you can't build it fast enough, maybe you just buy the guy who is.
So Amazon or Google could just swoop in.
It's a possibility. And then there's ClickHouse.
Right, the database unit.
Nebius holds a stake in it worth about $4 billion. There are rumors of a potential spin-off or IPO. If that happens, it could unlock a lot of hidden value.
It's like finding a $4 billion check in the sofa cushions.
Kind of, yeah.
So what's the bottom line? Let's bring it all together.
Well, the most immediate catalyst is Q4 2025 earnings. They're expected literally any day now.
And what are we watching for in that report?
Two things. Confirmation of the ARR run rate. We want to see it hitting that $900 million to $1.1 billion range. And, crucially, we need them to reaffirm that $7 to $9 billion target for 2026.
If they waffle on that 2026 number, the stock drops.
Big time.
Exactly.
Any sign of hesitation will be punished.
So if you had to put a score on it.
I'm giving it a bullish score of 8 out of 10.
That's pretty high, given the risks. What's the core thesis then?
The thesis is that this is a high-risk, high-reward play, but the floor is higher than people think. That $20 billion backlog provides a safety net, and the global power shortage gives them pricing power.
So it's a hold your nose and buy situation.
It's a multi-year hold. You have to look past the daily volatility and hold into that 2026 revenue inflection. You have to stomach the 4.0 beta. The 60x valuation is terrifying unless they hit that 7x revenue jump.
Which their contract suggests they will.
The demand is not the question.
So really, this is just a bet on execution. The only variable is, can Nebius actually build the data centers fast enough?
That is the only variable left. Demand is solved. Construction is the challenge. If they can pour the concrete and rack the servers, the stock works.
Well, it's certainly going to be an exciting couple of years to watch. That's our look at Nebius Group today.
It's a fascinating case study, for sure.
If you found this breakdown helpful, make sure to subscribe, like, and comment below. We'd love hearing your take. Are you buying this one or staying on the sidelines? We'll see you in the next one.